Welcome to the first edition of Mortar and Margins of 2026. Adam.
Morning, everyone.
You're going to talk to us about how to value properties.
That's right. We're about to play a video and I'm going to tell you about how we... So what we do is we look at comparables, a very stripped back version of what an RICS surveyor would do. We will look at what's sold, not what's on the market, but what's sold, ideally within the last 6 months, within a quarter of a mile. We often have to go a little bit further out than that, so we'll go out distance-wise a bit more before we go back in time. We've got a rough idea of what happened over the last few years in terms of the market in general. So we take certain years with a pinch of salt, say 2021, where the market was very hot indeed. We also use some automated valuation tools. There's lots and lots of them available these days. The most popular one is called Home Track, but we pay for that because we're a professional outfit, and that does have a cost implication. There are free ones available, Zoopla and things like that. Some people often chuckle a bit at Zoopla, but what I will say is it might not be brilliant on an idiosyncratic individual property basis, but it is pretty good across a portfolio.
Right, we'll dig in more into that, and we'll be talking about what this year holds for landlords, and also bring a little piece of Victorian wisdom, which I think is one of your own mantras, Adam. So welcome everybody, stick around. If you've got opinions, leave them in the comments. So Adam, you were talking earlier about how you value properties. Is this a process that you do on an ongoing basis? Is it something that you do at certain times of the year? How do you decide when you want to sort of look at your portfolio and say, okay, we need to know exactly what we're holding here?
So we will grab the data quite religiously. So we'll look at what Zoopla says. We'll look at what one or two of the other automated valuation models say. We'll update them at least once a year, and that would be on particularly steady state properties. I'm a strong believer that when you're building an investment company, whereas most trading businesses would look at their P&L every month, at least, aside from anything else, or they should be if they're trying to run it properly, apart from anything else. We would look at our balance sheet every month. We wouldn't necessarily find a reason to increase it, depending on how the market's going at the time, but we might revalue them as often as once a quarter, Duncan. And it really depends upon a number of things, such as how's the company financed, how is it backed, what's the person or people, the investors who've put the money in, what's their expectations in terms of reporting? Because if they're used to running a trading business, they're used to P&Ls every month. P&Ls on a monthly basis are not that useful when you're building an investment company, because aside from anything else, if you're doing a significant amount of refurbishment, you really need to think about segmenting your refurbishment that is supposed to add value at the beginning of a project, and then your ongoing maintenance. They're two different things, but sometimes for tax purposes, they're blended together. And I'll leave that chat to the accountants rather than pretend to be one, Duncan.
Right, okay. So do you find when you do this that you're often surprised at the results? I mean, do you find that individual properties really can vary quite widely and can perhaps be different to what you might be seeing in maybe a national average or even a regional average? Or do you find that actually generally you know what you're going to get?
That's a really interesting question, because I think a lot of the stock that we tend to buy is somewhat commoditized to a general rule. So it's a terrace or it's a semi, they're fairly similar. Having said that, there can be big differences. It depends on the area, and this is where a bit of local knowledge does come into play. How much is a parking space worth? And I'm not just talking in places like London or Bristol, let's say, where there's a real massive scarcity if you've got off-road parking. There can be little pockets, little suburban pockets, where parking is really difficult. And actually, a parking space or two might add 10% or more to the value of a property. You can have a terrace property which is straight out onto the road. You open the door, you go straight into the lounge. Very typical, very traditional. There might be ones with porches. There might be ones with little front yards. May not sound like much, but can make quite a big difference on the value apart from anything else. So there's an element of commoditization, but there is always those little idiosyncrasies within properties that can be interesting. And when you see that we buy properties at prices that are attractive to us, 80% of the time, 90% of the time probably, there's a reason why that property is that price. There is a problem that needs solving somewhere. So is that problem a permanent one with the location, the aspect? Is it on the end of the terrace and there's an issue with a bit of scrubland by the side of it, for example? Is there an undesirable neighbour? You know, are these problems solvable, or are they gonna persist, Duncan?
Right. Okay. And then, so you talked about some of the online tools you mentioned. You talked about Zoopla. You talked about, what was the other one you said? The professional tool?
Home Track, which is actually owned by Zoopla. Yeah, most
Right. Okay.
19 out of 20 of the top 20 lenders in the UK use Home Track to value properties. They use a very, very sophisticated version. But if you're dealing with any lenders that use automated valuation models, which we do all the time, and that's going to become more and more prevalent, of course, in the era of AI and cost cutting and all the rest of it, you really need to know what Home Track is showing. Home Track will show you comparables, but you can see what the lender can see then, or to an extent what the lender can see, and that's very, very powerful, of course.
And then, are there things that you tend to do as a result of this, or is it just really an accounting exercise to know where you're at? I mean, is it an action point that you come out of from when you finish these valuations?
Yes, because apart from anything else, especially in the era of more normalized interest rates, have you got an area where, for example, the capital growth is drastically outpacing the rent growth? And that can happen, of course, especially when you're down to the individual property level. Because if you've got a property that's packed on lots and lots in terms of capital value, but the rent isn't going up at all, generally speaking, for whatever local reason you've got there, then ultimately you might need to dispose of that property. So it could be. So we will also look when we have a change in tenancy, not just on a 3-monthly or an annual basis. We'll look when the tenancy changes over to say, actually, is this one we want to get rid of on the basis of its core metrics, if you like, rather than on the basis of another reason we might use.
Okay. And what about the external factors that affect house prices? What are the big ones that, can cause changes that are nothing to do with you? I'm thinking maybe, change in the council. I'm thinking schools opening and closing. What are the things that you kind of look out for in the area?
Yeah, schools can be a big one, and they can be quite subject to change, because quite often there may be one great leader in that school that has driven them to outstanding Ofsted and things like that. And if that great leader is 66 years old or whatever, then it's quite possible that might change over and there might be a bit of disruption there. We've certainly seen that locally. It's difficult because it's one of the reasons why when interest rates were low, we used to love buying 3-bed semis by good schools. These days, they don't really stack up from a rental perspective because the capital values are just too high or the rent isn't high enough. So that's more of an interest rate external factor, of course. You have to consider things like that. The broader credit conditions in the economy, which is why I spend quite a lot of time looking at it. There's nothing that affects house prices in general more than the availability of credit. But likewise, significant infrastructure developments in the area are going to put more pressure on the rental market, are going to mean more people are buying houses in order to let them to contractors on a short-term basis where they'll get enhanced rents for short lets and things like that. So those sorts of things can make a big difference. And I always say you're not necessarily looking for the places where billions of pounds are being invested. You're looking for the places where there's going to be a disproportionate impact on the local market. And that does go the other way, of course. If Nissan closes in Sunderland, we all know there's going to be a big problem, for example. If JLR have got a cyber attack, it might affect the economies of Solihull, Leamington Spa, Warwick, etc., etc.
Right, that must be a really big job for you, trying to keep on top of all these different areas, because you have housing all over the country, right? And for someone who has that, just keeping on top of these small changes that might be maybe not even a national news story, but can affect the local area very significantly. How do you do that? I mean,
we use it more to inform buying than we do worrying too much about disposal, because ultimately property is not massively liquid. One of the things we've been able to do successfully is make it much more liquid than the average. The average person accepts that it's 5 months in conveyancing to sell a property or whatever. We don't accept that because there's absolutely no need for it to be. The process is actually quite simple. It's just brute force work we've completed on properties before in 24 hours and 48 hours. By trying to make the illiquid liquid has given us an edge, if you like. So we can't worry too much about it, although we do try and keep an eye on what are the big strategic changes. So, for example, we bought a lot of property in South Wales, particularly South East Wales, when we knew that the toll was coming off the bridge and also the Bristol market was going so incredibly well. That sort of gravity of Bristol was dragging those prices forward. Once, and it just so happened that COVID came along as well, once that played out, the prices in Wales went up like a rocket. There was a lot of this sort of geographical arbitrage, and that enabled us to say, well, you know what, we're happy to dispose of some of those now because we've seen those outsized returns that we were expecting. But likewise, we're not expecting outsized returns for new purchases around there, apart from anything else.
Just give me an idea. What kind of churn is typical in your portfolio? How many properties are you turning over as a percentage, and what would you consider to be normal?
So we would be looking at, it's a really interesting question because part of this was driven by me. In 2022, I was aware of a company that had scaled quite quickly. They'd bought about 2,500 units. So they'd done quite a bit more volume than I'd managed to do. Private equity backed, venture capital backed, and all the rest of it. And in 2022, their backers turned around when Liz Truss was in number 10 and said, and this was after the mini budget and everything else, the market was all over the place, and said, right now, at this point in time, you need to prove liquidity and you need to sell about 20% of your stock and prove that you can do it, because you can do it in the down times. That's when we know we've got a really, really robust business model. So they bought reasonably well, and they were trying to release at the worst time I could possibly imagine, putting hundreds of properties into auction. And the auction market isn't so big that hundreds of properties doesn't make a difference, you know. And I sat back and I observed that. We actually bought a few things from them because I thought this is a terrible time to be selling. Why would you do that? But I then sat back and thought about it and thought the people who run these £50 million funds are probably smarter than I am, right? So what can I learn from that? And I thought that the thing that I learned was that proving of liquidity, apart from anything else. So is it okay to do the navel gazing 3-monthly exercise of revaluing your properties on paper? If you sell a property that you valued at 120k, right, you're not going to get 120k in the bank because you're going to pay an estate agent, you're going to pay a solicitor, you're going to do all these things, right? So therefore, what is 120k property worth on the open market, and how long does it take to realize that money? And the answer is, in our experience, about 92, 93% of that, because also you've got things like council tax for the voids, if you're going to sell it with vacant possession, blah, blah, blah. And actually all this leads down to a route of, it's much better for both landlord and tenant, if they're willing and capable, to buy it, to sell the property to a tenant in situ. And we've done that a number of times because we don't have a void. They get to where they want to be. It's a very, 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 and there's no estate agent involved in that process either, apart from anything else. So there can be significant advantages in doing that. But I decided that I wanted to prove liquidity, if you like, and also have real-time info on what was going on in the market. So the answer to your first question is, we turn over around about 3% of our stock every year. And there's a commercial reason behind that at the top level as well, because the thing that we do best out of all the things that we do in property is buying property, because that's where I focus the vast majority of my efforts, especially earlier on as I was building the group from the ground up. I knew that I needed to be a really, really good buyer and create a really good team of buyers in property. If you want to buy more without continually getting into more and more escalating debt, apart from anything else, if you want to scale the business, you've also probably got to do some disposals, because if you mortgage them to 75% of value. If you sell them, you realize, like I've just said, 92, 93% of value. So it helps you to keep those scales roughly on an even keel when you're looking at loan to value and important metrics like that across the portfolio.
Okay, I'm interested in what you said. I mean, you suggested, and tell me if I got this wrong, that when you look to dispose properties, one of the key things is, what are the costs of disposing that property going to be? Because regardless of the value of the property, there are some properties which you know that you can get rid of without, you say, paying estate agent fees, because you can sell to the tenant. There are some properties in areas, I guess, where you just know this is going to sell fast, and therefore that's going to save us a lot of money. Because when I worked at Microsoft, they used to have this HR policy. They don't have it anymore, which was essentially that they wanted to get rid of the bottom 10% of their staff every year. So they had this ratings system, and if you scored the bottom rating, and that was 10% of staff scored the bottom rating, they basically tried to shift you out, because they said, look, we know that if we get rid of the bottom 10% every year and we bring in a new 10%, chances are some of those new 10% are going to be outperformers. And then we can get rid of the bottom 10% every year, and that means we'll improve our staffing. I mean, it was a pretty unpleasant place to work. But is that something you look at as well? You say, look, here's the lowest performing portion of our portfolio and we need to move that on, because that's not something you mentioned just then.
No, it's the old rank and yank, isn't it? And the reason why it doesn't quite work as cleanly as all of that, aside from anything else, is so we're more opportunistic on our sales. We're looking at places where the tenant has vacated and then we're doing a review. I'm not keen on the idea of pushing people out because the corporate balance sheet suggests we need to sell that property
Right.
because it's in our 10% least performing. So we may well be not as kind as we might otherwise be on a rent rise in those situations. To be honest, it depends why is the asset not performing, and is that, and I guess it's the same in the Microsoft situation. Are those people not performing because they haven't got the right level of support, the right level of training, and all the rest of it, or are you just solely putting the blame on the person? So is it the property's fault, if you like? Is it something to do with the tenant? Is it just the fact that you replaced the boiler last year and you're going to get another 15 years out of that boiler? So don't worry too much about the last 12 months performance, because you've made an investment there that you're going to recover and get the capital back over the course of the next 15 years.
Okay, excellent. I'm sure there's a lot more we can get into there. I mean, I'd love actually to talk to you about the role of estate agents, being as that's something you mentioned, but I think it's time now to move on. So what I want to do now, Adam, is just take a look at a media article. Here we go. This is from the Telegraph newspaper. It's one of a kind of small series they've been doing into basically how terrible everything's going to be for landlords in 2026. And they make sort of three big points here. The new rules for landlords, higher costs and increased council powers, more interference from councils, and councils trying to clamp down on bad behaviour from landlords that perhaps could incentivise them also to go after some who maybe aren't behaving that badly. So you've had a look at this article. Is 2026 going to be the onslaught that nobody is prepared for?
I mean, they really have gone for it, haven't they? They've really pinned their colours to the mast. If you Google "buy to let is dead" Telegraph, I can't remember the year of the first time. I think it was the Times that had it in there before the Telegraph. I'm pretty sure it was pre-2008 when they first ran that article. So this is an ongoing theme, it's fair to say.
Hardy perennial, we call it in the business.
It works. It's like when the snow comes, it's like when the snow comes. There's some guaranteed copy there, isn't there? But I mean, are they wrong? Specifically, your last point about the councils and the local authorities, we'll see a huge variance of how these new powers are implemented. I would probably look to London, first of all, as the one that's going to set the tone. Of course, they're incredibly hungry for revenue. And of course, in the eyes of the local authority executive and staff as a general rule, there's a big problem with housing. Landlords are at least partially to blame for that problem with housing in the way that they see it. Therefore, extracting massive fines from them makes sense. So I'll certainly have an eye on the London councils to see how they implement these newfound powers that have already kicked in for them, and these new fines that they can put into place. Some of them are pretty eye-watering, up to sort of 35k and things like that. And they will be worrying people. And of course, the prevalence of that will then worry more people as it hits the industry press and all the rest of it. So that much is true. The article references the 2% extra tax that's been put on all unearned income, much as that's not a popular way of framing it. That is the economic way of framing it. But that doesn't kick in until 2027, of course. And look, a lot of landlords are not prepared for these changes in the law, but I think it's probably worthwhile pointing out that a good 50% of what the Renters' Rights Act is trying to address, there's already legislation in place for that. And legislation isn't the issue. Enforcement is the issue. But there are all these multiple reasons to go. Making tax digital is another one for people who are running very small operations. It doesn't mean anything to us because we already use bookkeeping software, and it's a button to press. It's no big deal. We keep everything up to date on a monthly basis. But the smaller you are, the more that's likely to impact you. There's a ton of stuff that people aren't going to like. Going on a register. I mean, we associate the word register with some pretty negative connotations in this country, don't we? That won't be for everybody, but already been happening in Scotland for a number of years, for example, and in Wales for a number of years. So we always kind of knew it was coming. The article also raises a very good point, though, about selective licensing. So this is one of these situations where it wouldn't grow like this from the ground up. But you've got parts of London, certainly I've got business partners that own properties there, where there might be a selective license in place, which is £2,000 for every 5 years, let's say. There's selective licenses in place in some parts of London per room for an HMO. So it's a huge revenue raising exercise, which of course puts further pressure on rents at the ceiling level. But when you're already pushing rents to people's affordability levels in the first place, the landlord does end up taking a lot of the pain in terms of that cost of delivery and compliance. And with interest rates being where they are, things stop stacking up so much as well. So while in London there's normally equity in those properties, there's normally an element of liquidity, but if it's something you're going to sell to another investor, I think a lot of people start a year like this and think with the intention of selling their properties, and then they realize the reality and some of the stuff we were talking about earlier on in terms of the liquidation costs, in terms of agency, in terms of just stopping your rental. If you want to try and sell a property vacant, you stop your income, and it's probably going to be 6 months before you get the capital back. Silly as it might sound, some landlords can't afford that, Duncan.
I think I would definitely challenge the nobody is prepared for the onslaught, because I would say, Adam, anyone who's been watching Mortar and Margins is going to be very prepared for it. I would say anybody who gets up at Saturday at 8 o'clock and watches a show about investing in property is probably going to be quite well prepared for this. So there certainly are some people that are. No, but I mean, I'm interested because you've talked about London quite a lot. I mean, and you've said, you don't like this buy-to-let is dead, but I think you've said for you pretty much London as a buy-to-let as an interest for your business is dead, right?
I'd agree with that, but then Duncan, it's never really been alive for me because I was sort of growing the business and starting to really scale it around 2014, 2015. And it was very, very obvious to me, although I got absolutely pilloried at the time on social media for saying it, that London had massively outsized growth. I've commented on a similar post this morning before we came online. Dubai prices up 30% year on year, someone was claiming. And my sole comment on that when I see it is that sustainable? Is that likely to be, that sounds more like something that gold or Bitcoin might do than what property prices might do. So it was already at the top of the market in 2014, 15. You started to actually see the market come apart in 2015. And people were saying to me, you don't know what you're talking about. You'll never make any money investing in Stoke-on-Trent, blah, blah, blah. And then in those 10 years, it's absolutely destroyed London, both for yield and for capital growth, which most people think there's this sort of holy trade-off between yield and capital growth. And it's just not the case at all. It's just a big urban myth in investing. So if you take one thing away from today's episode, yield and capital growth do not, by definition, trade off against each other.
Brilliant. Adam, thank you. Let's take another quick pause. And we're going to move on to our person of the week. Now, I'm not sure if you can see him behind me because I think the photo isn't great because it was taken a very, very long time ago. This is Wilkins Micawber. Adam, can you tell us who Wilkins Micawber is?
Fantastic Charles Dickens character. So sorry to break the theory of him being a real person, but he had an absolutely magnificent way of describing happiness and unhappiness when it comes to household budgeting.
Hold on that, because I'm going to come back to that. So Charles Dickens, David Copperfield, Wilkins Micawber is a chap who David Copperfield bumps into when he goes into London, and he kind of helps him out. But Wilkins Micawber is a guy with a lot of problems. Very optimistic fellow, always talking about his hopes for the future, but in debt, and he is, often seen as a kind of representative of Dickens' father figure, who, Dickens, I think, saw as well-meaning, but always struggled with money, and represents the kind of debt trap that could emerge in Victorian Britain, where you get into debt and then you get thrown into debtor's jail. You couldn't earn any money while you were there, so that you'd never pay off the debt, and you'd be stuck in this kind of spiral, living in accommodation and owing your landlord money, which, as you will know, is not a good place to be. But as I suggested, we do actually have some very, very rare footage of him explaining his kind of life philosophy. And I think, Adam, this is something which is really a maxim for you. I mean, it's something I will always associate with you. In fact, whenever I read Dickens, I'm thinking of this quote and I'm thinking of you. Let's have a listen.
Annual income, £20. Annual expenditure, 1996. Result, happiness. Annual income, £20. Annual expenditure, £20, 0 and 6. Result, misery.
So yeah, so if your annual income's £20, Adam, and that, I think if you put it into today's money, would give you about 33,000 pounds or something. I mean, there's different ways of converting it, but that's probably the equivalent salary of £20 back then. If you've got that and you are spending 19 shillings, what does he say?
£19, 19 shillings and sixpence. Yeah.
£19, 19 shillings and sixpence, which I think is £6 less than £20, then you're in a good place. And if you're spending £20 and no shillings and sixpence, then you're living in misery, because you're going to go worse and worse and worse. And that's definitely something that I think a rule that you tend to live by, Adam, right?
Absolutely. I think, I think the thing is, it's an advantage to start with nothing, I think, realistically. And I think a lot of entrepreneurs who are realistic would quite happily say that, because you remember that scarcity. And you see this I've obviously spoken to lots of people who've started businesses, who are in business for themselves. And that scarcity in their mind is something when it's harnessed correctly and it's used properly, it's very powerful. When it goes too far, you end up as Scrooge, of course, and you never spend anything, and you're deeply unhappy apart from anything else. So it's not just about income and expenditure, but lifestyle expansion is one of the most dangerous things for anybody's wealth in this day and age. And I've always talked about it in the same frame, Duncan, in as much as ultimately money can't buy you happiness and all the rest of it. But what it can do is it takes away some pressure, and it takes away some arguments. And the presence of it can take away a lot of problems. The bigger presence of it can introduce new problems, but frankly, they're first world problems, and you need to get over them most of the time.
I'll wait to find out about that side of the equation, Adam. But I did see you posted a bit of advice, which is your advice for New Year, which is forget all these highfalutin, ambitious New Year's resolutions. This is not about coming up with great plans and deciding all these enormous things you're going to do. If you want to be successful in this day and age, you've got to be doing the graft, and you've got to be doing something boring. I think what you said was, do something. What boring thing are you going to do every week that's going to take you forward? So I'm going to put that to you. What boring thing do you do every week that maybe you kind of don't really enjoy? I think maybe you do enjoy it because you're quite odd in that sense. But what boring thing do you do every week that takes you forward?
Well, every day and every week, apart from the else, I make sure that I'm researching what's going on in the broader market and thinking how I apply that to my own business. It's one of the first things I do when I get up every morning, is think about that. And that's a blessing and a curse to an extent, but I managed to try and harness it and compartmentalize it. So this is the whole point of putting structure. I'm not a naturally particularly structured person, so having an 8 a.m. on a Saturday morning to chat to you is a great thing for me. Having a Sunday supplement that I put pressure on myself to deliver every week, whether that's Christmas Day or whatever day of the calendar that it is good for me. So I embrace that structure and I harness it. And while I'm always learning and applying, I also know that I can help others by doing that. And that also has given me another business on the side in terms of consultancy, which I really, really enjoy. So I've managed to, where I'm odd is that I've turned those things that I really don't like doing into something that does lead to a result that I do like doing. And to an extent, I think I was reflecting the other day, I've actually gamified an awful lot of what I do. So I'm very active on LinkedIn, for example, but by treating it as a game with levels, with next targets, with all the rest of it, it turns it from a bit of a bind into a bit of fun, apart from anything else. So some of that's knowing your own personality type and trying to turn some of your weaknesses into strengths, apart from anything else where you can.
Right. So our advice this is the official Mortar and Margins advice for 2026. Do the maths, think like Mr. McCorber, work out what you need to do to make things work profitably. And if they're not, give them up. So we will be with you again, 8 a.m. next week, or of course you can watch us on demand through the week. Thanks very much for joining us.